Are you considering getting a mortgage or remortgaging, but worried about your existing debts? In this video, we'll address your burning questions and help simplify the process. First things first, let's understand what is considered as debt for mortgage purposes. Mortgage lenders classify debt as any money you owe to another party. This includes personal loans, credit card debt, store card debt, catalogue debts, bill or rent arrears, student loans, and even court fines. But does debt matter when getting a mortgage? The answer is yes. Mortgage lenders do consider the amount of existing debt you have when assessing your mortgage application. However, don't fret just yet. A mortgage application takes into account various factors, not just debt. So, how does personal debt affect a mortgage? Well, personal debt affects your debt-to-income ratio. This ratio compares the amount of money you have to pay out for existing debts against the amount of money you earn. Simply put, debts reduce your disposable monthly income and can impact how much the mortgage lender is willing to loan to you. If your debts are too high, you could potentially be rejected for a mortgage. Now let's talk about why mortgage lenders care about your mortgage repayments. Lenders have a responsibility to ensure that your mortgage repayments are affordable for you. They take into account your existing debts and the repayments you make on those debts. Additionally, lenders conduct stress tests on those repayments calculations to ensure you can still afford the mortgage if interest rates were to rise in the future. But what about payday loans and credit card debt? Do mortgage lenders care about those? The answer is yes. Mortgage lenders want to know about any payday loans you still need to repay, as well as the amount of debt on your credit cards. These factors are considered within the debt-to-income ratio and affordability checks. However, it's important to note that many people successfully get a mortgage or remortgage with existing credit card debt. Now let's discuss the impact of credit utilization on a mortgage application. Credit card debts are less likely to have a negative impact if you have a low credit utilization ratio. This ratio compares the amount of credit you've used on your credit card to the credit limit you've been approved for. If your credit utilization is 30% or less, it shows that you aren't relying heavily on credit. However, remember that many other factors contribute to a mortgage decision. Can you get a mortgage without standing debt? The answer is yes, but it depends on your specific circumstances. While it's less likely to get approved with multiple debts and court orders, even in such situations, there is still potential to clear debts and get a mortgage after rebuilding your credit report. But how much debt is considered okay for a mortgage? The amount of debt you can have and still get a mortgage depends on your personal situation and debt-to-income ratio. In many cases, your DTI ratio should be 36% or lower, with no more than 28% going towards mortgage repayments. Lastly, let's touch upon bad credit mortgages. These are mortgage deals specifically designed for individuals with poor credit, but who still want a mortgage. While they may not offer the most competitive interest rates, they can be an option for those with especially bad credit. Consulting with a mortgage broker who specializes in helping people with poor credit can be a wise move. To get an idea of how much you can borrow and the interest rate you'll have to pay on a bad credit mortgage, many lenders provide bad credit mortgage calculators on their website. Just remember that the representative rate displayed may not necessarily reflect the rate you'll be offered. If you're struggling with debt, then debt consolidation may be a good option for you, as it will enable you to make one simple monthly payment which may have a lower interest rate than your current debt. However, there are a number of debt solution options available here in the UK. Some are free to use and others will include fees, and each will have their own pros and cons. If you want to find out more about the debt solutions available, then we've created a really great form that you might be interested in checking out. Click the link in the description below to get started and answer a few simple multiple choice questions, like the total amount of your debt, how many people you owe, your living situation, and we'll connect you with one of our trusted partners so that you can find out more and take steps towards improving your financial situation.